So we've shown that people are willing to pay to reduce their risk. Hence, we have markets for insurance. To see this, consider a household that faces a risk of burglary. And they can buy some kind of homeowner's insurance policy that would replace their stolen items if they purchase it, so that they don't bear the cost of that themselves. Of course, burglaries don't happen very often. We'll assume a relatively high probability at 10%. And we want to think about how much this household would be willing to pay for this type of policy and what that means for insurance markets. So first, we'll begin thinking about a risk-neutral household and how much they would be willing to pay for this insurance policy. So if our household is risk neutral, we only really care about expected value. So let's think about the expected value here of being uninsured. The expected value would be 90% chance that there's no burglary and they retain all $100,000 in assets, plus a 10% chance that there's a burglary, which would cost them $20,000, meaning that they're really left with $80,000 in assets. So put that together and we can see that the expected value, if we're uninsured, is $98,000. So what's the most that they're willing to pay for this insurance policy? Well, they would be indifferent between purchasing insurance that leaves them with the same expected value of $98,000. So they're willing to pay up to $2,000 for insurance. If we take this $1,500 policy that's been offered to them, that's certainly a deal for them. They would purchase that policy, right? Because it gives them $2,000 in expectation for a cost of $1,500. However, the actuarial value of the insurance is $2,000. What does that mean? Well, it means that if all households have the same probability of the same outcome, then this is on average how much the insurance company would be paying out per policyholder. It's the actuarial value of the insurance, how much the insurance company would expect to pay out per policyholder. And that means that the insurance company in this situation would not be able to offer a policy for anything less than $2,000. So although the household would buy this insurance, the insurance company wouldn't offer it. Otherwise, they would be losing money. We do have some types of subsidized insurance in the US. We have crop insurance that's subsidized by the federal government, for example. I believe that hurricane insurance is subsidized in areas that are affected by hurricanes. But for the most part, our insurance markets are not subsidized. And so we would only expect people buying insurance who have a higher value of that insurance than the actuarial value. And so that means that only risk-averse people really benefit from purchasing insurance. But since most of us are risk-averse, that means that there is a market for insurance. So we'll see how that looks here in the next part, where we assume that the household is risk-averse. Okay, so now we'll suppose that this household is risk-averse and that they have this particular utility function. And then we then want to think about how much they would be willing to pay for this homeowner's policy. Okay, so just like in the previous example, we want to figure out what's the actuarial equivalent, what's the certainty equivalent to this lottery. So what's the expected value here for the household that is uninsured? That's 0.1 times log of 80,000 plus 0.9 log of 100,000 gives us 0.1 times 4. I've rounded here, 9, and 0.9 times an even 5. Okay, which is 4.99 utils. Okay, so that's the expected utility. I should say this is the expected utility from this lottery. And then we can look at what dollar amount with certainty is equivalent, gives us the same utility. That's expected utility as this situation with risk. So we can take our utility function here again. So we want to know what value of income with certainty would give us the same utility as this lottery. And so we've got log of I is equal to 4.99. So I will be equal to 10 to the 4.99 power, which gives me 97,723. Okay, so this is the certainty equivalent. And we can see here that this household is willing to pay a bit more than the actuarial value of the insurance, than $2,000. They're willing to pay an extra $200 some, right? So the risk premium is equal to the difference between the expected value and the certainty equivalent. So that gives us $277 that the household is willing to pay above the actuarial value of the policy. Okay, the premium, the amount of money they're willing to give up in expectation in order to eliminate their risk in the situation. Okay, so the answer here would be that they are willing to pay a total of $2,277 for this insurance policy. And now you can start to see why insurance markets exist, why they're profitable, and why they also improve outcomes for consumers, right? This household is willing to pay in order to reduce their risk. And that means that the household can benefit from purchasing insurance, assuming that the premium is something less than $2,277. The insurance company, on the other hand, can earn a profit because it expects to pay out about $2,000 per policyholder. And this is called risk pooling, right? So we all pool our risk together. Some people who observe the bad state of the world get a payout from the insurance company. Everyone else pays in. And in that way, by pooling our risk together, we reduce risk for everyone. And the insurance company can even earn some profit here. So this is beneficial not just for profits of an insurance company, because we'd like to limit those actually, but you can see that risk pooling benefits consumers who are risk averse.